This conference will now be recorded.
Okay, so we now begin our last month on the course, and in this last month, we begin to look at items on the balance sheet and look at special requirements and things we have to do. A few additional journal entries, but not that many, and we've covered most of them. But we're going to be starting with cash and going through every asset on the balance sheet and the liabilities. Liability, talk a little bit in detail. You have the basics now. You have the basics. You know how to prepare a income statement, statement of retained earnings, and a balance sheet. By the end of class today, we'll be into that final financial statement, the statement of cash flow, which we will go through the instruction on the preparation of it. So we start with the first account and the most important account. So you see on the cycle, cash in the bank, we purchase inventory, set up accounts payable, we sell items for cash and on account, we collect the receivables, we pay our bills, and then we see how much cash we have left in the business. So this is the cash cycle that we're working with, along with receivables. Accounting for cash is very important. It's an asset that can easily entice people to walk away with. I was meeting with the regional manager for Wells Fargo, several years ago, and he was telling me that he fires a bank teller once a month. So why do you think that's so? Well, just think about it. Keeping track, when some of you are going to be accountants, you're going to have clients, or you be working with businesses, and keeping track of numerous transactions of cash, payables, etc., can be challenging. And so there's certain things that we do to help the process. First of all, we utilize more than one journal. All sales and cash receipts typically go in the receipts journal. So we have a journal just with cash receipts. We post it at the end of the month. If we're taking in a lot of cash, we're going to have a daily cash sheet. Compare that to the cash register tape and to the deposit that's made to the bank. Then we have a cash disbursements journal. So we put all the disbursements in that journal and we posting those to the ledger. And then we have a general journal where we'll pick up all other non-cash transactions. So these multiple journals allow us to, let's assume we had 30 sales. Rather than posting 30 sales each day, we could wait till the end of the month, add up the 30 sales, and make one posting. So that's what these specialized journals allow us to do. And even if we had credit sales and cash sales, one column for cash sales, another column for credit sales, and then a total sales. So rather than making the postings daily, you could add up everything and post once a month. So that's what, and same thing with disbursements. And so this helps the process and simplifies it. Bank reconciliation. When you run a business or you're working with people who run a business and you're their accountant, you have to reconcile your bank statement. And then petty cash fund. Once you have, when you have small expenditures you don't want to write a check for, there'll be a cash box like what we have here. Most times now, a credit card is utilized to handle these expenditures. Internal control. You got to control cash. So when it's received, make sure it's counted, make sure it's deposited, make sure it's recorded. That's the lifeline of the business. And so we have to have internal controls in place to make sure all of these things happen accurately in a timely manner. And so here we have the process of internal control, a control environment, control activities, information and communication, monitoring, and then risk assessment. The control environment, we have to make sure that our environment is ethical. And if you're going to work for a company, you want to go for a company that has a ethical work environment. So that's the first thing we looked at. Then we have to have activities that aid in the control, cash registers, computers, programs, internal auditors. Then there needs to be information and communication. Then there's monitoring. Sometimes that monitoring is through spreadsheets, etc. Sometimes it's through cameras. Then there has to be risk assessment, where we're going to pay a lot of attention to areas where our exposure is great. So if you go into a jewelry store, the cheap jewelry is out there available, but that expensive jewelry is locked up. And that's in any store with this merchandise. Because the amount of loss is very large, then the risk can be great. Doing all that typing with their mic open. So whoever's typing, thank you. In the early 2000s, we had a bunch of financial scandals. A lot of them in Houston, Enron, to a later one, Stanford Financial Group. What these companies would do would be to prepare fraudulent financial statements, get people to invest their money in the company. They would then take their money out. Now, if you invest your money in a company and you buy their stock, your money is there. The way you get your money back is through dividends sometimes, but you have to sell the stock. So if you paid $100 for the stock and the stock is now worth $25 because the fraud has been discovered, then you're out of luck. And so people were doing this on a regular basis. A lot of companies in Houston was doing this. And so some people were prosecuted, and then the Sarbanes-Oxley Act was passed. And one of the key things about the Sarbanes-Oxley Act is that directors and key officers, such as the president and chief financial officer, have to sign that the statements are accurate. So people bring statements to you, we're doing well, invest in us. They now have to sign those statements. When they sign and certify that they're correct, it's easier then to prosecute them if there's an issue with the statements. You signed it, you said the statements were accurate, they're not, we're going to prosecute you. So what we were looking at in this chart is the COSO Internal Control Integrated Framework. And this is a widely used framework, and we've talked about the control environment, risk assessment, information control activities, and monitoring. And so a key thing is having a control environment. In summary, internal controls are the procedures and processes utilized by a company to safeguard its assets, process information accurately, ensure compliance with laws and regulation. The elements, they're here again: a control environment, risk assessment, control procedures, monitoring, and information communication. That control environment consists of a management philosophy and operating style that needs to be ethical, the company's organizational structure, and its personnel policies. Control procedures can include hiring competent people, rotating them on their jobs, mandatory vacations, separating responsibilities, separating operations from custody of assets, proofs and security measures. And if you're supervising people, the people working for you are under your control, and they impact your evaluation. And so you're expected to look at things like changes in lifestyle, close relationships with suppliers, so that they can take an order from a supplier, order the thing, and then get a kickback. Refusing to take vacation, borrowing from other people, excessive, substance abuse, unusual increase in customer refunds. These are all areas. Now, I had a student who was a salesman, and she said that she would get a commission every time she sold something. And so she began to get friends and relatives to come in and buy things. She would get her commission, and then they would return the things later. Eventually, refunds in a special account. That's why, you make that journal entry, you debit sales returns, and you credit cash. And so the account began to get large at the store, and this is a major retail store in Houston. So she kind of got, went overboard. So they began to look at the refunds and looked at the salesperson involved, and they saw all of these refunds for this salesman. So she lost her job. She had to come up with a plan to pay it back, so they would not prosecute her. Bottom line, be ethical. And there are controls in place where you will get caught. So in general, in the business environment, do what's right. Better to lose your job than go to jail typically. So unless you got 5 million clear when you get out, you just got a 200,000 or 300,000 has to be for your legal fees, so you can get a minimum sentence. So you won't have any fees after the lawyers get in there. They want retainers of 100,000 just to take the case. So if you're not in the millions, then I suggest, and anyway, just suggest, always be on the up and up. Okay, let's talk about a bank reconciliation. When you work for a company and you have clients, sometimes, well, most times, there's a balance in the books and there's a balance on the bank statement, and they disagree. So what you've got to do is to reconcile these two balances to see why there's a difference and make the corrections and necessary adjusting entries as required. There are typically two analyses that we perform. We do the bank analysis, which begins with a cash analysis according to the bank and ends with a correct cash balance. Then we do a company analysis, which begins with a cash per the checkbook and ends with a correct cash balance. So if we're doing a bank reconciliation, here's the bank component. Enter the ending cash balance from the bank statement. Add deposits in transit not recorded by the bank. Deduct outstanding checks not paid by the bank. Determine the correct balance. For the company, you're going to enter the cash balance that's in the ledger checkbook. You're going to add credit memos that have not been recorded, such as notes collected or interest paid by the bank. You're going to deduct debit memos such as service fees and customer checks, and you're going to determine the correct cash balance. So let's look at an example. And a former student wrote this problem. He was banking with Chase on April 30th at 12 o'clock p.m. The balance per Chase Bank was $20,000, and his balance in his checkbook was $20,000. At 1 p.m., Chase posted the following. They added $500 to his account for interest, and they deducted $100 for service charges. So the bank now showed a balance of $20,400. Sebastian at 6 p.m., he made a deposit of $3,000. He wrote a cash withdrawal of $500, made a cash withdrawal of $500, wrote a check for $1,500 to pay his rent, and so his checkbook showed $21,000. Looking at this analysis, what is Sebastian's actual cash balance? What is his actual cash balance? So y'all can't tell a person how much cash they got? Y'all keep up with y'all bank accounts? So Williams, what's the right cash balance?
Hold on, I'm looking over it.
You looking over it?
Yeah.
How much cash does Sebastian really have?
Is it 400?
He just got $400.
21,400.
Yeah, let's get to 21. You get hurt. How much the man got $400? He hurt you, said he got $400. Okay. So let's see how much Sebastian has. And what we're gonna do, we're gonna do a company analysis first. We're gonna look at how much cash he said he had, which is $21,000. Then we're gonna look at transaction he doesn't have. He doesn't have the $500 interest that the bank put in there. He doesn't have the $100 service charge. So going from his checkbook balance, we're gonna add the interest income, we're gonna subtract the service charge. And so now his correct balance is $21,400. Now let's go to the bank analysis where the bank said his balance was what is it, 20,400. So for the bank analysis, we got to put the 20,400 in. Then we're gonna pick up bank 3,000 of revenue. The bank doesn't have these two withdrawals of 500 and 1,500. So when we go to the bank analysis, we add that deposit in transit, we deduct the check and cash withdrawal, and we get 21,400. So they are both the same. A student has said that this analysis is a crisscross. When we get ready to do the company analysis, we look at the bank's information. So Chase Bank had things, we didn't have them. So we have to put those things on our company analysis. Then we get ready to do the bank analysis. We have to go up here and look at the transactions that Sebastian has.
Hello.
Hello. and we put them in the bank analysis to get our correct balance. Oh, that's Prudence. Hello, Miss Prudence. How you
Hi,
doing
I'm
today, stranger?
fine, thank you. I was trying to say, after your class, I wanted to speak to like your students real quick about like Deloitte, and if they're interested in hearing me out real quick after class.
You wanted to talk to them about what? Office, doing office hours?
About Deloitte, there's like a
Oh, Deloitte?
yeah.
Okay,
I'm gonna wait like after class.
okay.
Yeah.
I thought you were back to work with them.
Well, I'm available if they need help. I am available. That's part of what I was gonna talk about also. So if they do need help, I can help out.
So if you need help with your long study problem, you can check with Miss Prudence there. And if you took the delayed midterm and if you had problems, you should go to Miss Prudence and work with that and correct it, because she can, she can get into my Blackboard to get to it. Then she can recommend that you get some points because you came and worked with her and learned how to do it. So then you can get some extra points if you need those points. So that's for the regular exam for those students who are having trouble balancing. Okay, so let's see what a student should be able to do on bank reconciliations. Here you have the balance per bank. You have the balance per book, outstanding checks, deposits and transits, interest credited by the bank, service charge. So your job now is to do the reconciliation, starting with A, B, and C. So you're going to do the company analysis, then the bank analysis. So begin work. Do the company analysis, then do the bank analysis. Do we got the company correct balance yet?
$2,100 or no?
That man wants 20 more than 2,100, Huntsberry.
Wait, no. 21,000?
All right. The balance per books, how much do we have? 19,500.
And 500.
Plus interest income credit to us by the bank. How much is that?
So don't you add you
2,000.
add 2,000.
Less
And
the
then
service charge is what?
don't you gotta take away $500?
Correct.
So that's 21,000.
Yeah, see? That's why I have confidence in you, Huntsberry. Give you those hard quizzes, exams, and everything. I know you can perform.
No.
Okay. Let's go and do the balance per the bank now. So let's take a few minutes and do that with 20,000 being the first line that's going to be here. Keep on a roll, Huntsberry. How much is the balance per the bank analysis going to be? We're gonna add what? Deposit in transit, 5,000. The bank doesn't have.
It's 18,000?
Well, Huntsberry, you're doing well, but it's got to be the same as this number here.
Wait, so I did that. 1,000.
Then we gotta subtract the outstanding checks. And what's that
Wait, where?
balance?
Wait, I don't scroll back up. Was I looking at the right thing?
Deposit in transit, 5,000. You gotta add those.
Oh, I was doing, never mind. I was doing column B.
Again, we're still on column A.
Okay, well, never mind. I was looking at that column B.
So the numbers have to be the same. Okay. All right, let's do the B one then. So now you know how to do it. Let's go and do B. Starting with the company analysis and then moving on to the bank analysis.
$23,000.
Okay. So what do you have on this line, Ms. Berry?
22,500.
And what's on the next line? The interest income, how much is that?
1,000.
And the service charge,
Minus 500.
we have to subtract the 500. So what's our balance gonna be?
23,000.
3,000. Now let's go down to the bank analysis. We know that we have to pick up what? The balance per the bank at 25,000. What else we got to do?
Add 3,000.
We got to add 3,000 for the deposits in transit. And what else?
Subtract the service cost, a charge.
No, we got to subtract the outstanding checks.
Yeah.
We come back to that same 23,000. Got it? One other thing that we have to do, and I'm gonna let you all work, see on your own. Okay, these items, these journal entries have not been made. So when we get this cash, the bank tells us we got cash of $2,000, then we got to make a journal entry. Debit cash 2,000 and credit interest income 2,000. We're gonna have to debit miscellaneous expense for the bank service charge. $500, credit cash 500. So these items on the company analysis, for the items on the company analysis, we have to make journal entries, post them to the ledger. So these are a couple of new journal entries that you made based on the bank reconciliation. Now for Huntsberry and the A students, we aren't going to let them have something this simple. So they get a comprehensive.
Yes, you will.
You already got the other one figured out, Huntsberry. So
Okay, so
here is a company, and J.H.J. Car puts in $100,000 into the bank. Then its receipts from realm revenues are 20, 30, 40, and 50,000, a total of 140,000. they write these checks, 101 to 110, 121,000. And the checkbook shows an initial deposit of 100, weekly deposits of 140, checks written 120. The ending checkbook balance is 119,000. So all we did was, rather than just, give you the totals, I gave you the details, and you would perform this analysis. Bank statement comes in. It's got the deposit for 100,000. It has the January 9th deposit for 20, the January 6th deposit for 30,000. But for the January 24th deposit, which we recorded on January 21st, we said it was 40,000. They say it's 38, and they give us this 3,000 interest. So you're the accountant. What can be the causes of the deposit being listed here as 40, but the bank saying it's 38? Why would that happen? What would some scenarios be that would happen? Well, the bank could have made an error. They could have shorted you 2,000. So that's why you're doing the reconciliation, in case they key it in the wrong item. Or your employee could have recorded it wrong. Instead of 40, he should have recorded 38. And you're going to say, well, don't make that mistake again. Or it might have been 40,000 that came in that week, but he put 2,000 in his pocket and 38,000 in the bank. So that's why with the bank reconciliation, you want somebody independent of the person who's writing checks and everything and doing deposits to open it and do the reconciliation. So issues like that can be discovered and controls put in place to control it. Cash is very important. You got to have super controls in place to control it. Any questions? Okay. So Prudence, why don't you come on now and go ahead and make your announcement now. We'll take a break in action. You still there, Prudence? I guess she's waiting for the end of class.
She put out the info there
Hmm?
to contact her.
Okay, she said she's gonna make an announcement. So I was just giving her a chance now. But if not, we'll move on. And you got some homework problems in here, simple ones. And some that are a little more complex. And we'll get into assigning those next time. So you're just on it for the first time today. So you get a little break. Now we move to our last statement that we got to learn how to prepare. The cash flow statement. So what are the other statements that we've learned how to prepare?
That we
What?
learned already,
Yeah,
income statements,
okay. What else?
balance sheet,
Balance sheet and the statement of retained earnings. And I told you there were 4 statements. And so today you're going to learn how to prepare a cash flow statement. How to prepare a cash flow statement. In any business, the goal is to move from starting the business with cash, put it in, making this entry, put it in common stock, We want the cash to go up and the earnings to go up. Sometimes companies will have earnings going up but no cash. That is a problem. Okay, that's a problem. So this is where you got to begin to watch out for fraud. People will make an entry, debit account receivable and crediting sales, but they never collecting that cash. And so that becomes an issue. So it's a little different statement. It operates in a different way. But if you really are going to be able to analyze how a company is really doing, whether it's going to remain liquid, then you got to look at the statement of cash flow. And this is a public statement. You cannot just rely on the income statement and balance sheet. They're good, but you need a little bit more. Okay. When you graduate from college and get your job, it's going to be a good thing if you can make about $100,000 a year, buy some new assets, spend $40,000 buying new assets, pay off your student loans, and have money left over. So that should be your goals. To make $100,000, buy some new and different assets, a better car, bigger house, pay off your student loans, and have money in the bank. Still money left in the bank. That should be your goal. And so when we look at a company, it's the same thing. Operations is like salary. So they should have money in operations to expand. So they have to, buy new equipment, open new locations, pay off indebtedness and pay dividends, and have money left over. So when you look at a company, you got to look at the statement to see if that's happening. Or, you'll be missing one of the key statements. Everybody can say they have money, but they don't have any cash to back it up. So our president says he's a billionaire, but he owes $400 million to people at a minimum. So is he a billionaire? Other issues there, but just letting you know, it's more than just the income and balance sheet. I got that, but how much cash you got? Okay, let's look at how we're going to prepare a statement of cash flow. Something that a lot of people don't learn how to do, but when people are preparing fraudulent statements, then they have no way to look at that. So accounting majors, finance majors, especially have to be aware of the statement and look at it. We're going to review all journal entries. So we're doing this simply now for the time frame listed. If a journal entry didn't involve cash, we're going to delete it. And then we're going to complete a template. So I got a template. You just have to fill in the template and you will have a cash flow statement. Now, here is an explanation of the template. For a company, journal entries 2, 3, 4, and 5, short-term liability, are sources of the cash. Journal entries 7, 8, and 9, and 11 are uses of cash, and that difference is the cash from operations, which if it's not positive, then the company is not doing well. Then we have cash flow from investments. Journal entry 6, if you sell something. Journal entry 7, if you buy something long term. So these are all current assets, current liabilities. These are long-term liabilities. Then when you start the company, journal entry 1, you're down here in journal entry 5, long-term liabilities. Then journal entry 8, when you pay on long-term liabilities, and journal entry 10. So we have to group the first 11 journal entries in this format, put those dollar amounts from the journal entry onto the cash flow statement, add them up, and see where we are with sources and uses. So let's look at an example of how this is going to work out. This is the statement of cash flow that we're looking at. The first thing that we're going to do is to go in here and eliminate any transaction that does not involve cash. So if we purchase inventory on account, strike it. We're not going to use it. Cash sales were $1,200, cost of sales $600. We strike this because that's not cash. Sales on account, we're going to strike this because this is not journal entry 1 through 11. And we continue to do that. Now, here we're paying cash, pay salaries, we purchase equipment, $200 down. We'll look at that in a special way. Paid on accounts payable, collection on receivables, paid on long-term note, paid dividend, supplies on hand, the adjusting entry you just worked with, and we said an adjusting entry did not involve cash. Depreciation expense does not involve cash. Then we sold equipment costing $250 for $100. We only concerned about the cash. So in this analysis, we go through, first of all, and we eliminate any transaction, journal entry transaction that is not 1 through 11. If it's 1 through 11, we include it. If it's 1 through 6, it's a source. If it's 7 through 11, it's a use. So let's look at contributed cash of $200 to the business. Okay. So I got these down here. This is transaction 1. And so we're going to put the type of transaction is a JE1. And that was 200, so that's going to be so let's look at what we did. We looked at the first journal entry that involved cash. It was journal entry 1. Journal entry 1 comes in part 3. So the journal entries are listed by the part that they're in. So journal entries 2 through 5, 7 through 11 are in part 1. 6 and 7 are in part 2. If it's a long-term asset, short-term asset is up here. Then from financing, as we get to part 3, these journal entries are there, the long-term liability. So let's look at our next transaction. Cash sales were $1,200. So what do you think we're going to do with that? It's a type what? Cash sales of $1,200. What type is that? Do I have any C students today?
What's your question?
Cash sales were $1,200. What type of journal entry is that? Cash sales.
It's supposed to be at the top of that. Like, is it supposed to be on that list?
Okay, your journal entry types, you need to put that out.
Isn't it a two?
So what?
Isn't it a two?
Type 2.
Yeah.
Oh.
Type 2 comes here. So we're going to get that amount, 1,200. I think that's number 3, I believe. So it's going to be $1,200. And that's going to be JE2. So we're putting the JEs where they're on this template. So we just we're going through the transaction and putting in the dollar amounts. Purchase supplies, paying cash, 100. That's going to be what? A type 7. We purchasing a current asset. So that comes current assets, current liabilities. They're all in operations in the top part. So that's supplies, 100. That's transaction number 5. So the amount is 100. That's going to be JE7. So journal entry type 7. So we're continually going through every one we didn't scratch out. Paid salaries of 200. That's payment of expense J9. That's in the top part. That's a regular operating item. This is J9, 200. So we're just putting them in the location that they're supposed to be. Okay, we purchased equipment that cost 600, paying cash of 200, and signing a long-term note for the balance. The cash outlay is 200, but because it's a long-term asset we purchased, we're gonna list the 600, and then we're gonna list the note at 400. So we get back to the cash that was 200. So 47 is 600 for the JE7, the long-term asset. But also for 7, we have JE5 for 400, which is the loan. So in effect, we bought something for 600, we borrowed 400 to pay part of it, and then we pay cash down of 200. So that's a little different, but we want to show that you bought something for 600 and you owe 400. You didn't buy something for 200, you bought it for 600, you owe 400. Paid on accounts payable, that's simply payment of a liability as a current liability, JEA. So $700. So this is JEA. So these are journal entry types. Collection of account receivable. How you think we're going to handle that? That's journal entry type what?
3.
That's journal entry type 3. And so when we have a journal entry type 3, it comes into the top portion. So we're going to put JE3, and our amount was 500. Then we paid on the long-term note 200. So on the long-term note, we're paying what? $200. So that's transaction 10. And so we're paying 200. And that is a JE8, but it's a long-term liability. Then we paid a dividend of 100. So that's transaction, number 11. It's a payment, so it's going to be here. And that's journal entry, what, 10. So we've got locations for everything. And our file 1 sold equipment for $100. 100 is what we want. That's sale of a long-term asset. JE6, that's going to be in part 2. So we're going to put the 100 here. And that's going to be journal entry type 6. So what do? We look at these transactions and we scratch them out if they didn't involve cash, 1 through 11. Then, utilizing our chart, we place the dollar amount of those journal entries in operations, if they were a source of cash, or use of cash. In investment, if it was long-term assets versus current assets and current liabilities. Financing has the long-term liabilities, dividends, and contribution of stock. So now let's look at what our statement of cash flow looks like. We're going to add up our sources in part 1, 1,700. We're going to add up our uses, which is what? 1,000. And so tacking on a few zeros, we got 700,000 from operations. From investments, sources 100, uses 600. So we have a minus 500,000 from investments. And then from financing, sources 600, uses 300. So we pick up another 300,000 here. So what's our net change in cash? 700 minus 500 plus 300 is 500,000. So this is how you prepare a cash flow statement. And it's different, it's awkward, but you must determine whether there's cash in operations. That's what you got to do. Before you go work for a company, or before you invest your money in a company, or you tell somebody else to invest in their company, if they don't have any operations, it's a problem. That's like you having cash that you got from student loans and you don't have a job. You have cash for a while, but not long. Okay, so are we going to invest in this company or not? We look at this company, are we going to invest in it?
No,
No, why not?
because they're in the negatives.
They're what?
Because they're in the negatives.
What negatives? They have
That was
700.
just for investments.
They got 700,000 in operation. They are supposed to invest so they can expand. We want this to be negative. Like I said, this is just like you. If you graduate and you can't buy nothing, you get your school and you got a job where you can't buy any more assets. So a company has to do this, because if it doesn't expand, it'll just fold. Here they borrowed, they bought the equipment and did some things, paid off some indebtedness. But a little too much indebtedness, but overall it's okay. So it's not it's not the worst company. You could give it a chance, but you would not want to see a lot more of debt being created. Okay. So do we think we can do a statement of cash flow now? Just got to complete the template. Like I say, it's unique and different. We do it simply because we can analyze the cash transactions to get it done. Okay. And after we work some, so you just have to practice. So here's 4-1, here's 4-2, here's 4-3, and here's 4-4. And here's 4-5. So team 1, team 2, team 3, team 4. They lay right out there, right? Team 1, team 2, team 3, team 4. Your statement of cash flow. So these are not difficult. Just take some patience to work through them.
Wait, what are the
break
breakoff?
So
Oh,
what?
okay. I was trying to see what were the breakoff numbers.
Team 1,
Okay.
team 3, team 4. So once you get working on this, this is not going to be difficult, okay? Because over the summer and some last semester, I create you a nice little template. All you gotta do is fill it in. Now, if I gave this to you without a template, just gave you some transactions and told you to do a statement of cash flow, then that'd be another problem. All you got to do is go through here, do your strikes, put your things the way they're supposed to be, and you got a statement of cash flow. Okay? Okay.